Welcome back to Financial Accounting, and we are going to get started with a brief introduction, about 18 to 20 minutes, to just get us started in Chapter 5, because this is somewhat a long chapter. So Chapter 5, as you can see, is accounting for retail businesses. I have suggested in an earlier class, that I really would prefer that they use the term merchandising company rather than retail. Retail means that you are selling to the end user, but what we're learning also applies to companies that sell to function as a middleman, and maybe they sell to the retailer. So really what we're talking about is any company that doesn't make the product they sell, and then they buy the product and they turn around and sell it to their customer, which may not be the end user. So all it means is they're not the manufacturer. They're not making what they sell, but they do sell a product. You can see on the screen right now several learning objectives. Again, we do have a couple appendices to this chapter, and we will not be covering those appendices. You are not responsible for that information. You do not need to read that part of your textbook. As I said, for the last chapter, there could possibly be a question in the pre-quiz, but not likely. There definitely will not be anything that we cover in class. There won't be anything on the homework problem or on the exam related to those last two appendices, last two learning objectives on the screen. So our first goal is to understand the difference between what we are accounting for and the other types of business organization. We talked about in Chapter 1 the three main types of business organization. Manufacturers make the product they sell. Merchandising companies buy it from someone else. It might be the manufacturer, it might be another middleman, and they sell to their customer without really changing the product that they sell. And the third, and really the simplest form, is a service company, and those are companies that do not sell a product at all. Instead, they're selling some kind of a service, like a nail salon or a tax preparation firm, a landscaping firm, or lawn service, those kinds of things. Attorneys are good examples. Banks are examples of companies that are service companies. So the operating cycle for a merchandising company, which again is the focus of our work this semester, in managerial accounting, which is for most of you will be next semester. In managerial accounting, we shift our focus to manufacturing companies. But what you see on the screen right now is the operating cycle for a merchandising company. We call this from cash to cash. So you can see at the very top of that cycle, they have some cash available, and they use that cash to purchase merchandise that's going to be available for sale to their customers. They now have the merchandise and they're going to sell it to their customers. And then if they allow their customers to buy on credit, then there's another gap while they collect from their customer, and then they get the cash back. That from cash to cash is known as the financing period. So how long do they need to be able to float their business from the time they spend the cash to buy merchandise until they get cash back after they've sold it to their customers? As we go through the semester, we're going to be looking at a number of financial statement analysis tools, and there are a few that come into play with this diagram. So we'll be looking at these over the next several chapters, and in Chapter 14, where we end the semester, we'll be really summarizing all of this. So we have a way of measuring how long it is from the time that my text up here, how long it is from the time we buy the merchandise until we sell it. And we refer to that as inventory turnover. How quickly are we selling our merchandise? And there's a related measure of days sales on hand, days inventory on hand. So we have a way of measuring by looking at our financial statements, how long we have our money, or excuse me, we have our cash tied up in that inventory before we sell it. If we sell it on credit, then we have a way of measuring how long it takes to collect from our customers after we make the sale. And that's known as receivables turnover. So how long does it take us to get our money from our customer after we sell to them on credit? And there's a part here that's not really shown, but is definitely actually more likely than the accounts receivable piece. And that is, for most businesses, they're not paying cash when they buy their inventory. Instead, they would buy it on credit. And so there's going to be a gap between the time we buy the merchandise and when we pay our suppliers. And I'm just going to stick that up here because that's the piece that's really not reflected in this diagram. But it's actually more likely that we buy on credit from our suppliers than that we allow our customers to buy on credit. The bigger you are, the more likely you are to buy on credit. And so the way we measure that time lag is payables turnover. So all three of those we'll be seeing before the end of the semester. And we'll be talking about how these numbers can be used to really analyze both the operating cycle and the financing period for our company, or any company that we're analyzing. Our first learning objective for this chapter then was to see, well, how do our financial statements look different? In chapter 1, you learned how to make an income statement, and it was a very basic, simple form of an income statement. Revenues, list and total. Expenses, list and total. Subtract, find our income or loss. In this chapter, we're learning a financial statement known as the multi-step income statement, where we're going to add just a little bit more information, just like we did with the classified balance sheet. And we just saw at the very end of chapter 4, when we calculated our working capital and current ratio, how that could be helpful to have those classifications. On the income statement, we can also classify the information. And that's what you see over here on the right-hand side, this retail business. Instead of listing all of their expenses together, this company, which is a retailer or merchandising company, has actually divided their expenses into two categories: the product cost and the period cost. So rather than listing all of their expenses in one category, they have divided them. Product cost, which is the cost of goods sold. In other words, how much did it cost them to buy the merchandise from their suppliers? And our next chapter is actually all about inventories. And so we'll be talking about how do we know what that cost of goods sold is, what numbers go in there. And the other expenses are the period costs, the ones that are not related to our inventory. Another term for product cost is inventoriable cost. Inventoriable cost. And I'm going to put it down here, but I can tell you that spell check does not like this word. I don't know why it thinks it's not a word, but it doesn't. It is a word. Inventoriable means when you buy it, it goes on the balance sheet as inventory. So it's an asset for us until we sell it. And at the time we sell it, it comes off our balance sheet. It's no longer inventoried, comes off our balance sheet and onto the income statement, as you can see here. Cost of goods sold. So the product cost, another term for that, is an inventoriable cost. So, whoops, let me go back up for a second. I didn't point this out. So the first step, I said this is a multi-step income statement. The first step is sales minus cost of goods sold equals what this book terms gross profit. What you will see in most other arenas, you'll see it called gross margin. And so I will use both of those terms because you're more likely to see gross margin if you are looking at the company that you chose for your project. If you chose a company that makes a product, manufacturer, or a merchandising company, you will likely see a step on their income statement called gross margin. You're not likely to see it called gross profit, but that's the term this book uses for whatever reason. If you chose a service company, if you chose a bank or some other type of, an airline that's selling tickets, that's selling service, taking you from one place to another, you may not see a step that says gross margin. Just like on the left-hand side of this slide, the service business doesn't have a second step in there. So gross margin or gross profit is the difference between their revenues and their cost of goods sold. It's what's left of their sales after they pay for just the product itself, without covering any of the operating expenses, the cost of their accounting department, their human resource department, their marketing and sales department, anything else like that, and certainly actually making money. Okay, get that. So, what time is it? Got a few minutes left, so let's keep going just for a moment. I'd like to look at, before we run out of time, our first exercise to maximize the use of our time here. So many of the exercises we're going to be looking at in this chapter are looking at either purchases or sales and how do we report them? How do we record them? So we're going to be looking at transactions from both sides. First, the entity that's selling the product and the entity that's buying the product. And we're going to be talking about a number of different concerns or a number of different types of accounting questions we might have to answer. So how did they pay for it? How did they get any kind of a discount? Did they have to pay for the freight? And that kind of question. So looking at our brief chart of accounts here, these are part of the balance sheet accounts for this business. I just want to point out to you that they have their inventory. Inventory is pretty liquid. It appears near the top of the list, but it's not a financial asset. So they do have to do something. They have to sell that inventory and collect from their customers before they have that cash available. So when we talked about the current ratio in chapter 4, we were including all of the current assets, including inventory. But that inventory is not really available to help us pay our bills until something else happens. We have to sell it. And for now, just take note of that estimated returns inventory. We will be getting to that. We'll be using that in one of our upcoming exercises. And so I would like to go, before we run out of time, I would like to go to our first exercise in chapter 5. You'll always want to keep in mind the heading or the title of the exercise. So you can see here that we are going to be taking the part of the purchaser. These are purchase-related transactions. We're asked to journalize entries for the following related transactions of Lilly Heating and Air Company. The first thing we did was purchase merchandise. The merchandise cost us $36,000 and we bought it on account. What does that mean? We didn't pay for it yet. And so the credit is going to be to accounts payable. We bought it from Shell Company. We now owe Shell Company $36,000. However, it tells us the terms here. Terms of we would read this 110 net 30. That N stands for net. So we're looking at our first example of payment terms. When we agreed to buy this product valued at $36,000 from Shell Company, We said, yeah, but we don't want to pay cash for it, as we talked about in that diagram in the PowerPoint. We don't want to pay cash for it. How long will you give us to pay for it? And Shell Company tells us, we will give you 30 days to pay the whole invoice. That's what the N30, the net 30 means. We'll give you 30 days from the day of the invoice. We'll give you 30 days to pay for it. However, Shell Company doesn't really want to be out the money for 30 days. Remember, we talked about that financing period and the concept of receivables turnover. Shell Company would prefer to have us pay it more quickly if they can get us to do that. So how do you get them? How do you get our company, Lilly Heating and Air, to pay faster? Well, you offer them a discount. And that's the 110 part, or 1% 10. What that means is Shell Company has told Lilly, if you pay within 10 days, you can take a 1% discount. That's a pretty good deal. I'm going to tell you right now. How many 10-day periods are there in a year? 36 and a half, right? 36 and a half. If you can make a 1% return on your money 36 and a half times a year, that's a 36% return. Right now, well, the market's crashing, so you're not making any money. But even in an average year, long-term expected return in the market, about 8%, between 6 and 8%, depending on how much risk you're willing to take. And so a 36% return, just by paying a bill that you'd have to pay 20 days later anyway, you're always better off, almost always better off to take the discount when they offer it. But the reality is, at the time we buy the inventory, we owe them $36,000. And so we're going to record that we have $36,000 worth of inventory we didn't have before this purchase. And then we now owe Shell Company $36,000. Even if we have to borrow the money, we're still going to be better off to pay that in the discount period. And that's what we do. Why do I say even if we have to borrow it? Because if you borrow the money, you're not paying 36% annual interest. So you're still going to be better off to pay it within 10 days. I'd pay it on day 10, but you're still better off to pay it within 10 days. So the amount we owe is $36,000, but they're giving us a 1% discount on that because we paid early. So they're giving us a $360 discount on that inventory. So when we pay them, we're going to show we no longer owe them the $36,000 because we're paying the bill, right? We're not going to owe that anymore. We need to wipe out the entire accounts payable. But the cash we are going to spend isn't the full $36,000. It's only $35,640 because we're taking that $360 discount. And what that means is the inventory that we have is actually cost us a little bit less. And so I'm going to remove that from the inventory account. And if we have too much left here to get done, so I'm going to stop there. I thought letter C was the last part. So we're going to stop there because we're almost out of time. But does anyone have any questions about what we've done so far? All right, well, thank you for being here. If you have questions from the exam, make sure you get them answered, and I'll see you Thursday.